Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
All right, guys, we're going to talk about a topic near and dear to my heart: Roth IRA conversions.
Today I want to talk about how changes that happened last year may be affecting you right now. Today, Logan and I are going to talk about what to do if you can't max out your 401k.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Cole and Kaylee from Buska Retirement Solutions and Buska Wealth Management. We're going to talk about preparing for retirement, but before we get started, if you have a question that you would like to see answered on a future episode, please email us at info@retirewithbuska.com. All right, guys, we're going to talk about a topic near and dear to my heart: Roth IRA conversions. Just kidding. I know nothing about Roth IRA conversions, so hopefully you guys are going to teach me.
Absolutely.
Cole, when we talk about Roth IRA conversions, should I convert my traditional IRA or my traditional 401k to a Roth IRA?
Well, I think the easiest answer to that is it depends. Unfortunately, there's no immediate way to know if you should convert your IRA or 401k to a Roth. It definitely takes some calculations. Certainly you want to be working directly with a financial services professional that has experience dealing with that, tax issues, all of those types of things. Even better if they're collaborating with a tax professional, which of course we do in our office. But really what we have to determine is where your current income puts you in the tax brackets and determine if there's wiggle room within that current tax bracket. So if you're, let's say, $30,000 below the threshold of a tax bracket change, that may indicate that you have some wiggle room in your existing tax bracket to convert over to Roth. Now, one of the things that we typically try to avoid is pushing a client into a higher tax bracket to convert. So let's say you're in a 12% tax bracket right now. That's obviously the lowest that bracket has been for quite some time. So it makes a lot of sense to try to maximize that tax bracket wherever we can. So if there's wiggle room there, obviously that makes perfect sense. But if you're already at the top end of that bracket, then any money we convert would be taxed at the next tax bracket, which would of course be 22%, which is a 10% increase in the amount of taxes that you're paying. That might not be advantageous. Now, some people it might work for. And it could be valuable depending on what their future tax situation may look like. But it really is going through this full process of analysis to determine if it makes sense for you. There's no these people should and these people should not. So of course, that's where working with a financial professional really comes into play, because they can help you to run all of these numbers so you don't have to try to figure it out on your own. And again, they can help with monitoring for blind spots and other things that you might not even be thinking about as part of that and analysis process.
So we do the analysis and we decide we're going to convert. Kaylee, what are the benefits of converting?
So the biggest benefit is going to be on taxation. So any qualified withdrawals from your Roth account is going to be considered tax-free. And then it doesn't count towards your income for that year.
Right.
So a huge benefit is it won't push you into a higher tax bracket.
Yeah.
And then also it won't affect your Social Security taxable benefit. And also your healthcare and Medicare premiums.
Yeah.
That takes into consideration your income as well. So Roths don't count towards that either.
Yeah.
I think a lot of people don't realize that Social Security is taxed at different levels. And so the highest bracket would be the 85%. So if we can take from our Roth account instead of our traditional IRAs, then maybe we can push our taxable Social Security benefit amount down into the 50% or maybe even the tax-free bracket.
Yeah.
And the same goes for our healthcare and our Medicare premiums. We just don't want to push ourselves into a higher premium payment amount by taking from our traditional IRA if we can help it.
Yeah, I mean, one of the biggest things that we preach about is not only diversification of your investments, but also tax diversification is going to give you a lot more control in the future. Because, I mean, let's face it, we have a pretty sizable national debt in the country right now, and we're accumulating national debt at a pretty, a pretty alarming pace at this point. And it just brings to mind the possibility of future tax rate increases, future legislation changes that might cost us more money. So I think now is a really good time to be as proactive as possible in looking at the possibility of converting to Roth to lock in some of these low tax brackets that we're experiencing right now, and then grow those funds tax-free out into the future. Like Kaylee said, there's tremendous benefits through and through when it comes to your financial situation by having that tax-free pool of money that you can grow for the future, use tax-free down the road, or potentially pass tax-free onto your beneficiaries.
So what should I consider before I convert to a Roth IRA?
Well, I think some of the main things that you would want to consider is your current tax bracket and where your income after deductions puts you in that tax bracket. Are you right at the top end? Are you somewhere in the middle? Are you towards the lower end of that current tax bracket? That'll help us to dictate how much we could convert and keep you in that same tax situation. And of course, like I just mentioned, that's always our number one goal, is to try to minimize the taxation on those funds, but trying to control when and how we pay them, I think, is really empowering for a lot of retirees and pre-retirees. And so another thing to think about is your current age, because if you're under or over 59 and a half, that changes some of your ability to do conversions. We want to make sure that we're being mindful of what that means at our current age. So obviously, as we say a million times in these shows, work with a financial professional, make sure they're collaborating with a tax professional, because that's going to be the way that we go into that process with eyes wide open, so we don't deal with any surprises down the road.
And what are some reasons not to do a conversion from a traditional to a Roth?
Yeah, so there is the 5-year rule with the Roths, so the account does need to be open for 5 years. So for maybe a client who doesn't have as much time on their side, or maybe they need the funds accessible now instead of later, it might make sense for them not to convert into a Roth, but maybe just put those funds into a non-qualified account. And so the difference would be that they're going to pay taxes on the earnings in that account, whereas the Roth, again, it grows tax-free.
Yeah.
So that could be something to take into consideration. Also take into account the clients that might be in a higher tax bracket today, and then they anticipate being in a lower tax bracket in the future.
Right.
So that might make sense to wait to convert until we're in that lower tax bracket. Also, we need to take into consideration that once we do the Roth conversion, it can't be reversed. So they are irrevocable now. So we just need to keep that in mind, that we work closely with our financial services professional to make sure that we're reaching all of our retirement goals.
Yeah, absolutely. There's a lot to consider. It's not unlike anything else in the financial world. There's so many things to remember. There's so many things to know. And obviously, individual clients don't necessarily want to go out and have to learn everything about finance, which is the same reason why I don't change the oil in my own car and all of these things. I would much rather go to the professional and pay them a little bit of money to have them take care of it right the first time, so I don't have to worry about watching 5 hours of YouTube videos and, trying to figure it out and then probably inevitably messing it up in the end anyways, and then having to pay more to fix the problem. This is no different than the financial world. This is why we as financial professionals exist, so we can help with these areas that clients might not be direct experts in and maybe don't have the interest in becoming an expert. If you want to go out and learn all of these things and do the research on your own, absolutely more power to you. That's incredibly valuable knowledge to have. But at the same time, not everybody is as passionate about it as we are. And so sometimes it's a little easier to have a partner on your side that's working in your best interest, that's trying to help you to make sure that they're guiding you through all these different topics in the most proactive manner possible. I think that's really empowering and can provide a tremendous amount of peace of mind. And I think at the end of the day, that's what every single pre-retiree and retiree is looking for, is just to feel like they're going to be okay. They have somebody they can call when they have questions, and that somebody is working behind the scenes to make sure that they can maintain their long-term financial plans.
Yeah, absolutely.
Yeah.
Well, thank you both for answering all of my questions about Roth IRA conversions today.
You bet.
And thank you very much for joining us on Financially Speaking. We'll be back with more right after this.
Close your eyes and picture retirement for a moment. What does your dream look like? Would your days be filled spending time with family and friends? Maybe you desire to volunteer or work a rewarding part-time job. Or do you envision traveling the world? Whatever your dream consists of, Buska Retirement Solutions can help you realize it. Call or go online to schedule a complimentary consultation today.
Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. But if you're like many savers, you probably don't know the total taxes that you could end up paying. At Buska Retirement Solutions, we believe information is critical to making informed decisions. So I want to share with you a resource that can help quickly evaluate your potential taxes in retirement. Visit BuskaRetirementTaxBill.com to generate your personalized report. And once you've seen your retirement tax bill, let's talk, because there may be ways to improve those numbers.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management. Today I want to talk about how changes that happened last year may be affecting you right now. Now, there were several financial developments in 2023 that may have positive impacts on your financial strategy this year. U.S. News & World Report article entitled 7 Things Retirees Should Be Thankful For This Year nicely describes some of the good news from last year that may be giving you a boost in 2024. Changes to RMDs, or required minimum distributions, were a dose of good news in 2023. Beginning in 2023, the age you must take your first required minimum distribution from a retirement account was increased to 73. That extra time may help you delay income payments and reduce your taxable income, as well as provide longer tax-free growth within your accounts. And don't forget that the RMD age jumps to 75 in 2033, which means younger workers will have even more time to contribute and let their money grow. 2023 also saw a healthy 3.2% Social Security cost of living adjustment, which went into effect in 2024. Now, while that's a lot less than the 8.7% increase that went into effect in 2023, it was still a pretty solid increase. Now, when the cost of living adjustment was announced, the AARP estimated that the 3.2% increase would mean an additional $59 a month for Social Security recipients. All told, that should be more than $600 more per year, which may be making it easier for you to afford those higher grocery prices. The article next notes that in late 2023, the IRS announced that 401k contribution limits would rise in 2024. Specifically, the limit increased $500 to $23,000. And bear in mind that those who are 50 and older are now able to contribute a catch-up contribution of an additional $7,500, raising the limit for people in that age bracket to $30,500. Now note that your total contribution may not exceed your yearly compensation from the employer that sponsors your plan. Now, those new limits are also applicable to similar employer-sponsored qualified accounts like 403Bs and most 457 plans. Within that same announcement, the IRS also touted that IRA limits would raise $500 in 2024 to $7,000. The IRA catch-up amount has remained at $1,000 for those 50 and older. Now, those IRA contribution limits are the maximums that you can contribute each year across both traditional and Roth IRAs. If you have a traditional and a Roth IRA, you can't contribute more than that amount between both accounts in any given year. Now, saving interest rates have also been higher this year because, of course, interest rates rose. Several banks have promoted savings accounts with rates as high as 4 or 5% right now. According to the article, these are the highest consumers have seen in many, many years. Now, higher rates may also mean bigger returns on annuities, bonds, treasuries, and certificates of deposit. Be sure to review your current strategy with a financial services professional to ensure that you're taking full advantage of these rising rates. And if you have questions about contribution limits and catch-up contributions, those are conversations that you should certainly have with a financial services professional as well. Now, before I sign off, I'd like to segue into a different subject for just a moment. With inflation rising and the stock market going down, there was a renewed interest in senior discounts. An article in the U.S. News & World Report entitled Great Senior Discounts for 2023 noted that seniors could find discounts on everything from restaurants to cruises. Now, if you're on a fixed income, keeping an eye out for senior discounts can help you save some money while you get out and enjoy life. And don't be shy about taking advantage of the early bird specials that some restaurants offer as well. You may also be able to take advantage of some healthcare discounts. If you're a member of AARP, you may be able to get discounts at places like LensCrafters, Rite Aid, and Walgreens. Now, I'm just about out of time for this segment. To review your financial strategy, be sure to contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this. Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Buska Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review. You've worked hard to save money for retirement, but wouldn't you rather thrive and not just survive your golden years? My newly released book, Golden Rules of Finance for the Golden Years, offers key tips for managing your retirement money and ensuring you have a more complete plan to make your retirement dream a reality. Call 715-355-4445 or visit buskabook.com to request your complimentary copy today.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Wealth Management and Buska Retirement Solutions. And joining me today is Logan Waller. Today, Logan and I are going to talk about what to do if you can't max out your 401k.
That's right. While maxing out your 401k contributions is ideal, you're not out of options if you can't contribute that amount. In an article titled, What to Do If You Can't Max Out Your 401k, Investopedia has some tips for saving for retirement.
First, let's talk about what maxing out your 401k actually means. Is that like maxing out your credit card?
Not quite here, Cole. When you max out your credit card, it means you've used up all of your available credit. That's something you may want to avoid. The IRS allows you to contribute up to $23,000 to your 401k in 2024. If you make up contributions to that level, you're maxing out your 401k.
That adds up to quite a bit if you can swing it, right?
Yes, if you save that much per year for 30 years, it can add up to $690,000, not including any investment earnings.
Wow, that sounds great. But how much does that cost per paycheck then?
To save $23,000 per year, you'll have to have $884.62 taken out of your bi-monthly paycheck.
So about $1,916.67 per month.
That's good math, and that's right.
Well, that's great if you can afford it. But what if saving that much doesn't leave you enough to live on?
Well, as important as retirement saving is, I'm not of the mind that people should sacrifice their entire present for the sake of the future. You still need to pay your bills. You still need to live life.
Okay, so if you don't make enough to max out your 401k and still live in relative comfort, what should you do?
Well, the Investopedia article recommends creating a budget with the goal of setting aside as much as you can for retirement. The rule of thumb they recommend is to save about 15% of your total income.
I think that sounds like reasonable advice. Even if all you're able to save is a few $100s, that's still a source of funding that you'll have for your future retirement.
Exactly. Additionally, if your employer offers a match, you may want to make sure that you're saving at least enough to get as much as you can out of that. For example, if your employer gives you a 50% match up to 3%, meaning that if you save 6%, the company will give you a 50% match and give you 3%. You may want to make sure you're putting away 6%.
Now, if you don't take advantage of the match, you may be leaving money on the table.
Free money?
So if you save 12% and your employer gives you a 3% match, you'll reach that 15% mark.
Correct. If you can't max out your 401k, you may want to look at ways to get that 15% mark, and your employer's contributions may make that possible.
Isn't that what I just said?
Yeah, but I wanted to say it too.
So what are some other tips for people who are currently saving but can't afford to max out their contributions?
Well, you may want to consider paying down any debt you have, especially if it's high interest debt. Save money so you have cash in an emergency fund. Save for short-term goals such as buying a house. Once you have debt paid off, you may find more room in your budget for retirement savings.
Well, that makes a lot of sense. Now, if, for example, you're paying student loans, you're already used to setting that money aside every month. So when your loans are paid off and you start putting that money towards retirement savings, it won't really feel any different.
I'd argue that it will feel better because you're saving that money instead of paying a lending company, you're paying your future self.
Well, that's a great way to think about retirement savings. You're paying yourself.
Isn't that the old saying about savings accounts? Pay yourself first?
I love it, Logan. Now, how many people are actually able to max out their 401k contributions?
Well, Investopedia says it's only about 3.9% of workers.
Wow, I wonder what percentage of workers can afford to max out their contributions but just don't.
The article really doesn't say that, but audience, if you're watching this and you can afford to put $23,000 into your 401k this year, I encourage you to consider it. You may find it to be a good decision in the long run.
So how do you max out your 401k contributions, Logan?
Great question. Investopedia published another article with that very title.
Investopedia is a wonderful publication in my opinion.
I'm inclined to agree with that, Cole.
So what do they recommend?
They recommended gradually increasing your 401k contributions to maximize your savings over time.
That makes sense. So when you increase it gradually, you'll slowly get used to putting that money away. And when you have the entire amount taken out right away, it can be a little bit jarring. It's like, where did that $800 go?
Precisely. Save 10% one year, 11% the next, and 12% after that. Eventually, you'll get to that high level and you max out your contributions. In fact, the article says that increasing your contributions by 1% can yield tens of thousands of dollars more in retirement account by the time you get to retirement.
That's great news. So what else does Investopedia recommend?
The article talks about taking advantage of your employer matches, which we've already talked about.
Right.
It also suggests considering other options. IRAs, HSAs, annuities, taxable investment accounts are all things you may want to try to further your retirement savings after you've maxed out your 401k.
So let's go through those options in a little bit more detail.
Well, unlike 401ks, IRAs are available through brokerages and fund managers, so you can open one even if your employer doesn't offer it. Traditional IRAs are similar to 401ks, while Roth IRAs are taxed up front, which means you don't pay taxes later on when you withdraw the funds.
So what's the contribution limit for IRAs right now?
The limit for 2024 is $7,000.
Well, that's somewhat more achievable than $23,000.
That's right. It doesn't add up to quite as much in the end, but it's still added up. That's $210,000 over the course of 30 years. It's not nothing.
So what about health savings accounts or HSAs?
With an HSA, you can put away pre-tax income to pay for certain medical expenses. The money you save in an HSA can make your out-of-pocket costs a lot lower.
That's great. And what about annuities?
An annuity is a contract between you, the investor, and an insurance company. You make a payment either in a lump sum or in installments over time, and the insurance company pays it back to you. The insurance company makes payments back to you either immediately or at some point in the future.
So when the insurance company makes the payments in the future, that's a deferred annuity, right?
That's right. And Investopedia says it may be the best option for people who want to increase their retirement savings.
So what about taxable brokerage accounts then?
You won't get the same tax advantage with these accounts like you get with 401ks or IRAs, but if you get good returns from these accounts, you may find a taxable brokerage account to be a valuable alternative to a tax advantage account, or an excellent addition to one.
So what else do investors need to be aware of as they strive to max out their contributions?
Well, you may want to avoid taking money out of your retirement accounts. You may face penalties for taking that money out of your account too soon.
That's right, and there are some exceptions to those penalties, right?
There are, though I don't think we have time to go over them all here today.
You're right. I think we're almost out of time. Now, if you want to talk about maxing out your 401k or what you should do if you can't quite afford it, contact our office today at retirewithbuska.com or call us at 715-355-4445. We'll be right back with more Financially Speaking after this. Are you ready to make your retirement planning more stress-free? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make securing your future easier. By creating a comprehensive retirement plan that incorporates retirement income solutions, investment management, estate planning, tax strategies, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review. Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. But if you're like many savers, you probably don't know the total taxes that you could end up paying. At Buska Retirement Solutions, we believe information is critical to making informed decisions. So I want to share with you a resource that can help quickly evaluate your potential taxes in retirement. Visit buskaretirementtaxbill.com to generate your personalized report. And once you've seen your retirement tax bill, let's talk, because there may be ways to improve those numbers.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. Now, this is the exact same way that we communicate with our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan, so call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV and radio show, or to schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.